Hi, let's cover my two Elliott Wave scenarios on Bitcoin on the daily time frame, starting with the scenario that would lead to the lowest price, where the move to the downside from the all-time high is counted as a 5-wave impulse labeled as a wave A or 1, followed by a 3-wave correction to the upside in B2, and then you look for another 5-wave down in either a wave C, 1, or a wave 3. It doesn't really matter which one it is, because in the end you're looking for a 5-wave structure down, and depending on the size of the structure and the retracement to the upside afterwards, we know exactly what we are dealing with. Now that move towards the downside can be counted as a wave 1, 2, 3, 4, 5, and in this case, locally here, you would like to see volume decline as price is making some low. So at the moment you can see a lower low on price on decreasing volume. That is something you would like to see to increase the probabilities of a bit of a bounce to the upside when price is touching areas of support. Now I do have an interesting area of support over here between 102.7k and 100.1k. So if price can move towards the downside, slow down as well as it is approaching this area of support on decreasing volume, the probabilities increase to look for a bounce back towards the upside here. Bears are then looking for a wave 1, wave 2, and then 3, 4, 5 later, where this wave 1 internally is counted as a wave 1, 2, 3, a long 4 in time, but no invalidation in price, and then a wave 5 towards the downside, 1, 2, 3, 4, 5-wave structure. Yesterday, I mentioned the probabilities are highest to look for downside, and we're keeping an eye on the potential wave 5, and that would be true in this scenario if you count this as a wave 1, 2, and then look for a 3 towards the downside. The other option, which at the moment, based on the local volume, would have some lower probabilities, is a straight line to the downside. So 1, 2, 3, and then 4, and then 5. Basically similar to what you had over here. You just go down in a straight line. We want volume to increase as it moves towards the downside. And 1, 2, 3, 4, 5, wave 3, most commonly extends. It's like the strongest, most impulsive wave with the highest amount of volume. A common minimum target for your wave 3 is the 1.618 extension, sitting at 94.8k, so that is a level to at least keep in mind. But we do want volume to increase as price is moving to the downside. We are basically looking for price to move more vertical from a more horizontal structure. Look at the curvature, more horizontal to more vertical. This is what we like to see. That is what we saw here as well. You go from basically horizontal to vertical. And in the end, an impulse to the downside basically follows a bit of an S curve. You move down, and then you go back horizontal. Horizontal, vertical, horizontal. It creates this S movement, this like wave structure, Elliott waves, no pun intended, but it has like this wave type of structure. So if we're really looking for acceleration, you want price to move towards the downside like this. You want it to go down, like you don't want price to move horizontal and then eventually look for price to move back towards the upside. So you really need volume to increase and price to extend. But at the moment, that would be an alternative, because so far price making another low on decreasing volume on a 1-hour time frame, 15-minute time frame. We can also see here that price is quite clearly slowing down again. So it increases the probabilities to look for a bit of a bounce. And I do have some areas of support to the downside over here between 102.7 and 100.1k, which is interesting. So if price can move to the downside a bit further, preferably also in a bit of like an overlapping slow structure to the downside on decreasing volume, it increases the probabilities for price to find support on these levels and then move back towards the upside and look for areas of resistance. You can see quite nicely here the latest move to the downside, even on a 5-minute chart. You can see the mess over here, quick move down, and now you start overlapping once again. It just increases the probabilities for at least a little bit here of a move towards the upside, but preferably I would like to see supports touched. And at the moment, I don't really have a nice area of support here, like a horizontal level, as you can see, because I pretty much turned everything on and there's not much going on at the low here. I did have a daily naked point of control on my chart here, which was traded through. It didn't give any reaction whatsoever. It was not interesting at all as price moved down into the daily naked point of control on peak volume. It doesn't provide an opportunity because you really want price to slow down as it moves into an area of support or resistance, so that it increases the probabilities for a bounce back towards the upside. Great example, this move to the downside, we had a monthly naked point of control at 105k. Price comes to the downside here on high volume, but then it slows down, creates another low on decreasing volume. It increases the probabilities for a bounce once you hit some important areas of support. Monthly naked point of control touched, moved all the way up to the double top to grab the liquidity, and then down we go again, of course. But those areas of support are interesting to keep in mind as long as price is moving down on some decreasing volume, and preferably it starts to create that like overlapping, like grinding structure to the downside. Now the short-term price action is then actually quite similar compared to what we look for here, right? So this is also, again, a move to the downside where we like to see price slow down. Preferably would be nice to touch areas of support, we'll see. But then you're also looking for a move up. But this move up preferably is bigger and it should be motive. And that's the difference with the bearish scenario, arguably, where if we look for a wave 1 and a 2 up, this move to the upside is going to be corrective. And then you look for price to move down. So you're looking for an ABC or a flat structure, ABC, or a WX and a wave Y. It doesn't matter. There's many different corrective structures, but you're looking for a 3-wave corrective move to the upside. Here, which is a flat, wave A, wave B, wave C to the upside, you want a motive wave to the upside. 1, 2, 3, 4, 5-wave structure to higher prices, not a 3-wave structure. And that's an important difference. So if price can move towards the upside, it's generally easiest for people to try and count motive waves, either an impulse, 1, 2, 3, 4, 5 of the low, a multi 1, 2 to the upside, 1, 2, 1, 2, 1, 2, which is 5, 3, 5, 3, 5, 3, and eventually you continue to the upside in a larger wave 3 to the upside. So 5 waves up, of course, that's your higher degree 1, 3 wave down, higher degree 2, then you get a lower 5-wave 5-wave up, lower degree 1, lower degree 2, etc. And then you move eventually in a wave 3, or a diagonal. Now diagonal would be the lowest probability, but that is basically 1, 2, 3, 4, 5, correction, continuation. If you cannot count an impulse, a multi 1, 2, or a diagonal with high probabilities, and preferably an impulse or a multi 1, 2, and a multi 1, 2 generally starts with an impulse. So bottom line, if you can't really count an impulse to the upside with high probabilities, the probabilities are higher, you're looking at a corrective structure. You don't even necessarily need to know what kind of corrective structure it is. The bias is set. If price would move up here and the probabilities are lower that this move towards the upside is an impulse or a motive wave structure, you're looking for price to go down and take out that low. If the probabilities are higher, the move towards the upside is a 5-wave structure, you're looking for a retracement and you're at least looking for another leg up to take out this high with the potential of continuation to take out higher highs over here on the left, like 116k. Now you can see that I have a big wave C here to the upside, right? So you have a 3-wave A, you're looking for a 3-wave B to the downside. So this then has to be a 3-wave structure to the downside. Area of interest for B is touched, basically between 104.8 and 98.6. Don't want price to touch the 10618 at 95.5, as that would significantly decrease the probabilities for wave B of a flat structure. So we want price to basically find support in this box, and we do have confluences in the box here as well. You can see the lines on my chart over here, and we want price to move towards the upside. So we want price to once again approach those levels, preferably on decreasing volume, bit of sideways like grinding, slow price action, overlapping, increasing the probabilities for a bounce. And then we'll see. Is it going to be a 3-wave structure to the upside? Is it a 5-wave structure to the upside? That's just time. We'll just sit on the sidelines, manage accordingly, provide more updates on YouTube, do our analysis. But in a more like bullish case, basically, preferably in a flat A, B, C, your wave C takes out the end of wave A, which is the high at 116. And then we're looking for a wave C, and after wave C though, you still move to the downside. However, this scenario at least opens the door to more bullish cases where the low formed here is actually the end of a corrective structure. Now, I don't want to make things too complex, but if price would move to the upside here in a 5-wave structure and does not take out 116K, the probabilities decrease for this move up to be a wave C and increase for this 5-wave up to be either a wave A or a wave 1. So then you look for a retracement and continuation to the upside. A nice example of this is what happened in the 70 to 40K range or 50K range, where over here, I remember price moved towards the downside over here and moved up impulsively. One of the options here is then, of course, well, there might be a flat over here. However, as you will go to my videos, you can go to 2024 early May. A flat here would be a running flat. This is your A, that's your B, that's your C. Wave C did not take out the end of A. A running flat is the rarest flat structure. So this therefore increased the probabilities that this move up was either a wave A or a wave 1, increasing the probabilities for a corrective move down and continuation to the upside later to at least take out this high, and then you just follow along and see where price goes. So that is something that you would look for if price moves up in a 5-wave impulse structure but does not take out the end of wave A. The moment it does take out the end of wave A over here in a 5-wave structure, 1, 2, 3, 4, 5, then the retracement matters. Now this can be a wave C, A, B, C, and then you go down, continue this range, right? Or go to much lower prices, because a flat can be part of A, B, C, and some other scenarios. I don't want to go in detail, but this move to the upside over here, after a wave C, if we really want to look for lower prices, we need an impulse down again. So 1, 2, 3, 4, 5, correction, and then boof. If the move down after a potential C over here is corrective, you get a 3-wave move to the downside, like a WXY, for example. You're looking for price to move up, and this is not a C, instead it's a wave A or a wave 1. And that's also what I write here. The high could be a wave A or 1, but that depends on the retracement. Because the bulls are then looking for a 3-wave corrective structure to the downside, while the bears are looking for motive wave structures to the downside. So we take it structure by structure, range by range. Generally with Elliott waves, it does not make any sense to think too far ahead in time. It is important to know what to expect. So hey, if we look for a bounce over here, if it's 5 waves up, right, and doesn't take that high, we look for higher probability A or 1, correction, look for continuation. If we get a 5-wave up that does take out this high, then the retracement after matters. If that retracement is corrective, we look for continuation. If it is motive, we look for a bigger move down. If the move to the upside here is corrective, we look for a move down. So you can see that this is how you find potential similarities, looking for a bit of a bounce here, as long as price is moving to the downside on decreasing volume, bit of overlap structure, preferably into support. We can look for a bounce, but then the structure of the bounce is going to decide the probabilities of what comes next. 3-wave up, down, 5-wave up, potential for continuation. If you don't take out the high, if you do take out the high, the retracement matters. As simple as it is. And that's that. If price here continues to the downside, volume increases, we look for lower. If price touches the 1.618 and 95.5, you're not looking at a flat anymore. Low probabilities. So this is how you can simplify things as well. And you can also see that I am not bothered by counting this whole range, because honestly it doesn't matter. Right? It really doesn't matter. You can have this as the end of a bull market and count a 1, 2, 3, 4, 5 and you go much lower. Maybe over here, this is a 5 of a lower degree, A, B, C down, you continue up. What? Does it matter? No, it doesn't, because the scenario here is going to be the same anyway. You're looking for a 5, 3, 5, depending on the move down, we'll see what's up. For a flat structure, this ABC can be a wave X, this ABC can be a wave B. You can finish a wave Y here at the low, WXY double zigzag, or WXY sideways complex structure. You can see that the structures I show here are isolated from the higher degree counts because they actually don't matter. Right? What matters most is what I show on my chart in order to keep things easy and not too complicated. So then we go to the levels. You've already seen the levels, of course, now numerous times, but these are the volume levels, most interesting levels that I have. And personally, I find these most interesting. So the volume levels, you can see the support just below a price, and to the upside, you can see the resistance. Then we have the high time frame horizontals, or just time frame horizontals. I should actually just change this folder to TF. There we go, time frame horizontals. Whoa, there you go. All right. And then we have an order block at about 120. I do think if price is going to move above 116, you're going to move straight up to about 120 at least. Okay. Then we have the news. So this is the news. So Monday, Tuesday, Wednesday, and Friday, there's news on the agenda. Times are Central European time zone. Make sure you trade safe because it can increase volatility. And finally, before I talk about the conclusion, I'm not looking at a wave C here anymore of a larger flat, by the way. I just want to answer this question that I got, an ABC, where this is a wave 4 and this is your final leg down in a 5. Reason being that if this is a wave 4, it has to match a wave 2. It's either going to be this one candle to the upside or it's going to be this wave 2. Now, if I take a Fibonacci from this potential end of 2 then to the current high, price touched the 618, which acts as an invalidation for wave 4, low probabilities. And you can imagine that if this is going to be your wave 2, and then I take a fib from that high to the low, right, the end of 2 to the end of 3, you didn't touch the 618, so that's something. But if that's your one candle wave 2 and this is your wave 4, you can imagine that the ratio is no bueno, right? We don't like to see this, very ugly. Your wave 4 is like 20 times the size or more compared to your wave 2. Does not make any sense. And if this is your wave 2, then price touched the 618, which invalidates a wave 4 basically, and therefore would invalidate that all of this is part of a same impulse. So therefore probabilities are higher. You have a finished structure, and this is something else. But it's not part anymore of a wave C to the downside. Alternatively, diagonal, but low probabilities, not relevant at the moment. So then we get to basically the conclusion. Locally, price is slowing down over here. Right? Not a low on decreasing volume at the moment. So keeping an eye on support and the potential of a bounce up, that's interesting. The low that then forms can be wave B of a flat, according to the scenario showed here, can be wave B of a flat and price moves up. Or in a bearish case, you want a motive wave up. In a bearish case, you're looking for a wave 1, 2, and then a 3 down for lower prices. And for the biggest bulls, this can of course also be a wave Y and you go up. But we'll see that at a later stage. Like bulls, and I said that in the previous daily time frame video, bulls have time. You have so much time. You can go 2 videos ago. I made a video, this one here, 24 minutes long. I made a video where I said, if you're looking for price to move up, you got time. There's no hurry to try and look for a swing trade or a position. You need to wait here and see what the range shows, because you're going to be in this range probably for a couple more weeks. And the same is true now, also with the scenarios shown here, where if you're bullish, well, this is obviously bearish, so you're going to be in this range for a bit longer and then you move down. Of course, bulls are looking for price to move back up, but you got time, right, before price shows itself. And here you're just going to continue this range. And being bullish only happens really at a later stage. So you got time. Bulls really have time. There's not really a reason here yet to be like, I'm going to invest, or this is a great swing trade opportunity. I'm not a financial advisor, right? But from an Elliott Wave point of view, patience makes a lot of sense in this range, at least for the bulls. So bulls have time. You're going to be in this range for weeks. No need to snipe a low. Snipe probabilities instead and wait till they are clearly in your favor. Right? You want the bull probabilities to be in favor. At the moment, it's too early to really call bullish probabilities the most favorable probabilities. You don't necessarily need to snipe a low. One can always wait for 5 up, 3 down, and that becomes the opportunity to then look for price to continue towards the upside. But it requires patience and control. Right? Self-management instead of management of your position. So a lot's been covered in this video. Hopefully it's useful, and yeah, I wish you a good day, right? So thanks for watching this video. On the left, you can see a video on the simplest way to use and trade Elliott Waves without even counting, and on the right is the Elliott Wave educational playlist to help you understand more about Elliott Waves. Thanks for watching and subscribing, and I hope to see you at the next one. Bye-bye.